Hello, today I am going to talk about the latest quarterly financial performance of tire companies. These companies have posted an in-line set of numbers given the weakening demand outlook from automobile segment and increase in the raw material prices. Let us discuss the key highlights from the results. First, talking about the top line growth, these companies have posted a subdued volume growth primarily because of the weakening demand coming in from the automobile sector both in the India and international market. Talking about companies specific, CEAT posted a growth of around 8.9% in its top line as compared to the same quarter last year. This growth was driven primarily because of the value growth or the price hike taken by the company to pass on the raw material prices. Volume growth was mere 2%. MRF on the other hand posted a growth of around 6.2%. The company has posted the lowest growth in the space, primarily indicating that the company has been losing the market share to the other players. Apollo on the other hand posted a strong growth of around 16% in its top line in this quarter as compared to the same quarter last year. This is primarily because of the growth coming in the replacement segment, where the company generates around 30% of its domestic revenue. Moving on to the operating profitability, all of these companies have posted a huge contraction in its EBITDA margins. CEAT witnessed a EBITDA margin contraction of around 356 basis points and its EBITDA declined by around 23.7%. This is primarily because of the inventory buildup and the higher ad expenses. Apollo Tyre witnessed a contraction of around 108 basis points. MRF on the other hand posted a huge EBITDA margin contraction of around 483 basis points, primarily because of increase in the raw material prices and negative operating leverage. Now, moving on to the stock outlook, there are a couple of factors that we need to watch out for in the tire company space. First is the domestic automobile industry outlook. Domestic automobile industry has been reeling under multiple blows, primarily because of various macroeconomic headwinds led by increase in the interest rate, subdued economic activities ahead of elections, mandatory long-term insurance leading to increase in the price of the vehicles. All of these factors put together have led to the subdued consumer sentiments and subdued demand from automobile segment. Replacement demand, however, continues to be very strong. What we believe that the demand would be sluggish in near term, however, the long-term outlook continues to be very strong, primarily because of the government's focus towards infrastructure, increase low penetration of passenger car, two-wheeler segments. So overall, all these factors continue to give positive outlook for this sector overall. Moving on to the second factor, which is the raw material prices outlook. Tire companies operates in a fragile industry dynamics where it is very difficult to pass on the increase in the raw material prices. Crude and natural rubber form the major part of their raw material basket. Natural rubber continues to hover around at around 125 per kg as compared to 126 per kg recorded by the companies in the Q3 of FY19. What could provide a margin expansion for these companies is the significant fall in the crude prices, and as these companies use the various crude derivatives, and the fall in these prices would lead to increase in the operating profitability. And finally, the attractive valuations. Amid the weak demand outlook and the stock market volatility, all of these companies have corrected quite significantly. Among these companies, we advise investors to accumulate CEAT and Apollo on the back of their attractive valuation. At the moment, we avoid MRF as it has been losing the market share to other players or its competitors. Overall, all of these companies are in the sweet spot to take the advantage of the growth coming in the domestic automobile industry. That's it from my side. For more news and update, please log on to moneycontrol.com.